How foreign investors affect your investment portfolio. If your country is a developing nation and you are investing in your developing country through stock markets, then you should know these few things first. Countries are classified into two classes, known as advanced countries and developing countries. Advanced countries are those countries that are rich than developing countries. Advanced countries also have latest technologies as compared to developing countries. Advanced countries are rich because they have developed their economies. Most advanced countries export more and import less, therefore they have positive trade balance. That means they are making a lot of profits by exporting their goods to other countries, because of which cash is flowing into their home country and they are spending less on imports by manufacturing goods in their home country. Because of this incoming cash, these advanced countries are spending a lot of cash on research and development to improve their technologies so that they can stay ahead from their competitors. Advanced countries also have highly educated workforce, which helps to keep them in a leading position in the whole world. Advanced countries also have positive trade balance. Developing countries, on the other hand, are exporting less and importing more, therefore they have negative trade balance. That means they are buying goods from other countries, because of which cash is flowing out of their country. Developing countries also have shortage of latest technologies and shortage of educated workforce, which is a big barrier for further development. As advanced countries have developed their economies, they do not need funds from other countries to fund the development of their country, as they have enough funds for their country's development. On the other hand, developing countries do not have necessary funds to develop their countries, so therefore they need to depend on other countries for funds that have positive trade balance. The financial markets of advanced countries have economic stability, while the financial markets of developing countries are unstable. If you are living in developing country, you will notice that your stock market fluctuates a lot, and the big reason behind this is foreign investors of advanced countries. As advanced countries have a lot of cash and therefore they invest that huge cash not only in their home stock markets but also invest in stock markets of various developing countries. So again, if you are living and trading in the stock market of developing country, you will see that your portfolio value fluctuates a lot, and this is because foreign investors buy huge number of stocks worth billions of dollars on the stock markets of developing countries. And when they buy stocks that are worth billions of dollars, your portfolio value increases immediately. And when the same foreign investors sell their stocks, your portfolio value goes down immediately. So if your country is politically unstable, or there is a high tax on investments, or your country's financial situation is not good, then these foreign investors can sell their stocks immediately, and you will see that your portfolio value goes down. This is a big problem in developing countries, as there is a lot of political instability. There is a lot of corruption, less developed financial markets, high tax, and their financial markets are less developed. But why these foreign investors of advanced countries invest in developing countries, even if they have highly advanced financial markets? Well, the answer is simple. That is to make huge profits. Look, advanced countries have already developed their country and also their stock markets. So with this high level of development, there is little room for growth. For example, take any advanced country and check its stock market returns or equity returns for last few years. And then take any developing country and check its stock market or equity returns for last few years. And then compare those equity returns between these two types of countries. After comparing, you will notice that stock markets of developing countries has generated huge stock market returns as compared to stock market returns of advanced countries. Now you will think, how can this developing country with less developed financial markets and less developed economy and less developed technology can generate huge returns when compared to advanced countries that have well developed financial markets and latest technology? Well, the answer is not that confusing as you might think. The answer is simple and easy, as developing countries are not working still at their full capacity, and therefore there is a lot of room for further growth. Let me help you to understand this concept with the help of an example. Assume there are two trees of same kind and the maximum height they both can reach in their lifetime is 20 feet, and one of the tree has already grown to a height of 15 feet and therefore it can grow just 5 feet more because it has a limit of 20 feet, and another tree has reached a height of just 4 feet. That means this second tree has lot of room for further growth and that it can grow more for 16 more feet to reach a height of 20 feet. This same theory applies to both advanced countries and developing countries. As advanced countries have already reached a height where there is little room for further growth, these countries try to invest their funds in developing countries' stock markets as there is a lot of room for further growth in developing countries' stock markets. This tells us that financial markets of developing countries are controlled by foreign investors of advanced countries, as they have huge capacity to invest billions of dollars in the stock markets of developing countries. The big problem with developing country is that their citizens do not invest or trade through stock markets on a very large scale. Now it is not that the citizens of developing countries stay away from stock markets. Even these citizens from developing countries trade or invest through stock markets, but not on a very large scale. The next big obstacle with these developing countries is that they suffer from high inflation. That is, the prices of goods and services are very high in their country, because of which people of these developing countries have to spend huge cash to buy these goods and services, and because of which they do not have enough cash to save and invest through stock markets. As people of developing countries have lower salaries when compared to advanced countries, there is little cash left after buying necessary goods and services, and hence people find it difficult to save and accumulate enough cash to invest or trade through stock markets. And because of little trading or investing activity of the citizens of developing countries, they cannot control the stock market of their home country. And this is where foreign investors come into action, as they have a lot of cash on their hand and they can invest billions of dollars in the stock markets of developing countries, and because of which these foreign investors of advanced countries control the stock markets of developing countries by buying and selling stocks on a very large scale worth billions of dollars on trading days. This is a big reason why people of developing countries that invest in the stock market of their home country find their stock portfolio value fluctuating on a very large scale from a very high level to a very low level. Now there are a lot of different reasons why these foreign investors buy and sell stocks on a very large scale on the stock markets of developing countries, which causes the stock market of developing country to go up and down. As I have already told you that political instability, corruption, increase in tax, less favorable atmosphere for foreign investors to invest causes these foreign investors to sell their stocks from the stock markets of developing countries. And when these foreign investors sell their stocks, they sell it at a huge profit. But the people who suffer the most from this outflow of these investments from foreign investors are the citizens of developing country who invest on their home countries' stock markets, because the portfolio value of developing countries' investors falls immediately when these foreign investors sell their stocks without any warning. So, if you are new to investing or trading through stock markets, and if you are learning any new stock market concepts from your so-called stock market expert, and if your so-called stock market expert tells you that you do not have to worry about these foreign investors, and that the stock market is not affected by these foreign investors, and that the stock market index will always go higher and higher in value, then the stock market expert is completely fooling you, and that so-called stock market expert is fraud. And stay away from such foolish advice, because the reality is that these foreign investors of these advanced countries affect the stock markets of developing country on a very large scale because of their huge trading and investing activities on developing countries' stock markets. And that's a fact. The goal of this video is to make investors of these developing countries to understand that there are a lot of fraud so-called stock market experts that are teaching wrong concepts, and at the same time misleading investors, because of which a lot of investors who have followed the advice of these fraud stock market experts have lost a lot of cash in the stock market. So always remember that you can make a lot of cash in the stock market if you carefully study the stock market yourself and make logical investment decisions, and stay away from these fraud so-called stock market experts, and at the same time understand the risk and opportunities that the stock market offers. If you enjoy the video and want to learn new interesting things, then remember to like and subscribe and click on the notification bell, because there are a lot of new interesting videos on the way.